Welcome to MarketTamer.com, and special thanks to Professor Jeremy Siegel of the Wharton School of the University of Pennsylvania for allowing us to use his information here. We're looking at the causes of the current crisis as articulated by Professor Siegel, and the true cause, he notes here, is buying, holding, and insuring large quantities of real estate and risky real estate-related securities with borrowed money. And he notes that the irony of this is that banks didn't have to hold these securities. In fact, if you were looking back over time to identify why did nobody, or why did very few people certainly anticipate the correction, one of the reasons is that there was concentration of risk. Not necessarily that people had not identified a bubble of sorts, which we'll come to later in the presentation, but that it was difficult to understand the correlation of risks because there was a close concentration of risk in the banking industry. Unlike, for example, the 1998 to 2000 bubble, where risk was spread among many, many firms, in the banking industry, it's so small that risk was connected and so contagion could spread when issues arose. So it wasn't the usual source of bankruptcy. It wasn't due to lack of demand for services or products, and it was very different than the problems facing other industries such as the auto industry. The issue with a financial firm is that it's essentially, as John Mack said, a confidence game. Because of fractional reserve lending, equity levels are low, leverage is high, and ultimately if everybody took their money out of the bank, there would be a bank run. And so we all trust and believe in the system, and so we all have confidence in it, hence it works. Banks will loan out based on certain ratios, and if those levels are violated, then the equity gets drawn down. There can be a risk of a bank run. In the case of the firms that did liquidate and went under in the recent past, the confidence in the firm dissipated, and when that happens, obviously it's very, very difficult for a bank to sustain itself. And so unlike maybe back 100 years ago, where primarily banks did not lend nearly as much as they did today due to differences in fractional reserve lending levels, today, because those levels are so small, equity can be wiped out very quickly. And finally, we'll talk about the Great Moderation in a couple of moments. So here, if we take a look at GDP over the past 50 to 60 years or so, what we see is what's called the Great Moderation, which is smaller and smaller changes in GDP. And that's evident here also. Back in the 20s, you can see that the Great Moderation occurred also prior to the 1929 crash, smaller and smaller changes, and of course then there's a spike up. And it's just so easy to get caught up in the expectation that when there are smaller and smaller changes in GDP, that volatility levels start to diminish. When volatility diminishes, obviously we see the volatility index decrease to extraordinarily low levels, which we saw over the 2005, 6, and 7 period. And because of that, investors are seeking higher and higher returns, but it's very difficult to attain those returns without volatility, and so the only way to do it is really to lever up. As a result, during periods of great moderation, we see investors seek out more and more risky investments, and we see banks and issuers create vehicles such as securitized vehicles, collateralized debt obligations, and so forth, structured investment vehicles, in order to try and lever up and try and generate higher and higher returns. And in retrospect, it's perhaps easy to identify the bubble, but at the time of a bubble, it's very hard in the midst of a bubble to actually say that it is one, whereas in retrospect, we can look at various measures and say for sure this was a bubble. For example, looking back over time using the S&P Case-Shiller Index, we can see that house prices divided by median family income shows over the 2004, 5, 6 period that there was essentially a bubble forming. In fact, if you were to look back over 400 years in the Dutch markets, you'll see that real appreciation in home prices is not that substantial at all. In fact, it's fairly flat. Nominally, of course, prices do rise over time, but real appreciation in home prices is not necessarily a proven phenomenon if you look at all sorts of markets. So with that said, if you have any questions, we look forward to seeing you at MarketTamer.com.